$1,000 in 2026 if I were to start all over again and didn't have an $18 million net worth. I'm Kiana, the Invest Diva, former engineer turned 8-figure investor, here to help you accelerate your financial freedom with triple compounding. I'd put the first $200 in an S&P 500 index fund like VOO. This gives you instant exposure to 500 of the top US companies. That includes Nvidia, Apple, Microsoft, Amazon, and Google. I'd put the next $300 in high income dividend stocks. Why? They pay more than high yield savings accounts. With interest rates going down in 2026, yields are going to be capped below 4%. And these individual dividend stocks pay more than a high yield dividend index fund. For example, WES pays 9.30%, Dow 8.93%, and PAA, my favorite, pays 8.83%. I'd split the remaining $500 like this: high growth potential, steady, and high risk, high reward potential.
So basically, taking this in consideration, she's more or less diversified this small, let's just say, investment of $1,000 over, Vanguard, high income. So things that essentially, obviously, income generating some yield. Vanguard, S&P, ETFs, you can't go wrong over a period of time. And then she's put it into individual stocks, and then also in Bitcoin. So I think you also really need to take a look at the current environment that we are at the moment. We're setting is quite unprecedented in terms of the market's at all-time highs, right? The stock market is at all-time highs. Precious metals is at all-time highs. We're seeing potential fears of civil wars taking place in America, continual potential wars all over the world. We're seeing a de-dollarization as well, that's uncoupling. So you need to really take all these things into consideration before just adhering and following someone based on these suggestions, right? So if I just pull up this, you can see base asset class returns by decades, right? So going back from 1930, just after the Great Depression, all the way up until now. So you can clearly see we've got S&P 500, small caps, 3-month T-bills, 10-year treasury bills, real estate, gold, inflation, right? So you can basically see here that S&P essentially really over the course of decades here have been generating, nearly double-digit returns, which has been phenomenal, right? Small caps have done also quite similar. If you average this out, we've got S&P 500 doing 10% per year. Small caps 12%. 3-month T-bills 3.3% averaging out. 10-year treasuries 4.3%. Real estate 4.6%. 5.9% for gold, 3.2%. But what you're seeing with gold, which it will basically hasn't showed up now, but it will probably show up in 4 years, so once this decade is over, that this has been a massive outlier for the last decade, right? It's the last year has literally tripled or more than doubled essentially. So this will be totally skewed to the upside. So I think you need to take in consideration where we are in the current market and having uncorrelated assets, right? Because what's happened with this investor or influencer basically just saying a lot of it is based on S&P 500, and then also S&P 500. She also said individual stocks, right? But S&P 500 actually has Microsoft, actually has Google, right? So what I would do basically is you cannot go wrong with S&P 500, but you need to take into consideration where we are. We're at all-time highs. Potentially, we got the midterms taking place this year. So there could be a lot of things that could actually derail the returns. And then because of this safe haven asset of precious metals, that people are allocating more capital towards silver, gold, because of this uncertainty, right? Markets topping out. So I would look at allocating with precious metals. I also look at with treasury bills is tough because now interest rates looking to go down, so there'll be more yield. Real estate, obviously with 1,000, you can't really invest in anything. But if you had a larger portfolio, real estate has some phenomenal tax advantages in terms of depreciation of your real estate. You've got also 1049 exchange that you can also do. So there's very, very interesting. I think a lot of the wealthy, uber wealthy, they love real estate, right? Because obviously there's a lot of things that you can be able to do with especially with the income. You can move a lot of your income over to things such as real estate. So long-term power laws, you cannot go wrong with real estate. However, we are now starting to see, based on the high interest rates, and then with the burden of all of them to maintain a property, then you then have to then say to yourself, okay, net, is it really working out? So once interest rate comes down, this will be more interesting. Precious metals, I think liquidity is really, really important now, today, that you can basically just allocate an investment for the year, 2-3 years, and just let it run, right? And then also finding ways that you can generate more income that could be added to the compounding passive income that you're generating from these investments, and you're just compounding. So if you like this type of information, how to make money, how to preserve capital preservation, tax areas, please like, subscribe, and follow. Thank you.